Welcome back to Closing Bell East Africa. My name is Michael Mjisha. Now, Mauritius Bank, MCB, recently closed a deal for $800 million to diversify its funding profile. And now we're joined by Deputy Chief Executive Officer Raoul Gufflet for more on this. Raoul, thank you for joining us from Port Louis, of course. Tell us more about this $800 million. We understand that when you first launched this in January, it was just $500 million, but $800 million is a lot. So touch base with that.
Good afternoon, everyone. Yes, indeed, we just closed a dual tranche syndicated term loan facility of $800 million, the proceeds of which are going to be used for general corporate purposes, including trade finance. Back in January, we appointed Standard Chartered Bank and Sumitomo Mitsui Banking Corporation Europe Limited as coordinators and book runners. They've been followed by Citibank, London branch, as also book runner. The idea was to raise 1-year money and 3-year money through this dual tranche. Actually, we initially launched at 300, but then we thought that 500 was a much better figure for us to target. So the general syndication we launched in January was $500 million. And we elected to upsize the transaction to $800 million in light of the significant commitment we received. It's needless to say that the syndication was extremely well received in the international loan market, despite the fact that we haven't been on this market for close to 10 years, but we reaped commitments in excess of $1 billion. Why this large oversubscription, you will ask me? It's essentially a strong market interest that testifies of the international recognition of MCB's investment grade creditworthiness, and also the lenders' confidence in our strong fundamentals and the growth prospects. It's important to note that for the past 6-7 years, MCB has had an history of growing its international loan book outside of Mauritius, and this year is the first year where more than 50% of our balance sheet is actually originated from outside of Mauritius. So obviously we've been leveraging on the size of our deposits up until this year, and we realized that we could not fuel the growth of our activity only with the deposit that we've been attracting through Mauritius as an international financial center, and this is why we decided to go to the loan market. At the same time, trying to diversify the network of banks we've been working with for the past 180 years. And the idea was essentially to try and tap the Asian market, also the Middle East market, where there is excess short-term liquidity. Right. So we create roadshows, both in China, in the Middle East, and in Europe, to try and maximize the amount of money we would raise. Right. And this is how we reach more than $1 billion that we then scaled back to 800 million.
Right. Raoul, definitely when you speak about the appeal to international investors, pretty much means that you didn't have so much of a complexity drawing the fund together. So let's jump onto how this could actually have an effect on African markets. What do you see this is bringing to different African markets, not just Mauritius, but the entire continent?
What we expect as a bank is to increase our capacity to provide finance to the large conglomerates all across the African continent, where we have defined an appetite for risk. So we have identified a few countries where we would like to engage partnership and relationship with large conglomerates, and this addition of funding in our balance sheet will help us provide those facilities to the large conglomerates all across the African continent. But what I would see as well is also to create momentum for other banks on the African continent and other countries on the African continent, for them to realize how important it is to achieve investment grade rating targets, both at country level and also at bank level. Because what international banks are actually looking for when they want to place their excess liquidity is a secure and safe environment. And I guess that what they've seen, not only with MCB, but also with Mauritius, right, because both MCB and Mauritius are investment grade rated, is to create this awareness of how important a rating is for African countries and African banks to be able to tap those international markets the way we did.
Raoul, I have about 30 seconds before I let you go. What is the strategy for Kenya? We see you looking at entering this market.
Well, we have a representative office in Kenya. We've been doing a lot of trade finance business in the energy and commodity spectrum in Kenya. We are probably one of the main providers of finance for the bulk procurement system of petroleum products in Kenya, and we deal with most of the indigenous standalone importers of petroleum products. We use our rep office to be able to target the landlocked countries in Africa, Rwanda, for example, but also all of the eastern part of Africa, leveraging on the fact that Mauritius has agreements with many of the COMESA states and SADC. But we do not have yet ambitions to make acquisitions on the African continent and especially in Kenya. So for the time being, Kenya is a lending base, not only for the bank, but for all of the other entities of the group,
Raoul,
for us to grow our franchise.
Raoul, thank you very much for getting time to join us today on Closing Bell East Africa.
You're welcome. Thank you very much.
Right. That was Raoul Gufflet. He is the Deputy Chief Executive Officer for MCB Mauritius Bank there, giving us a quick look into the $800 million that was a deal completed last week. Allow us to leave it right here for Closing Bell East Africa. More from the east of the continent is tomorrow at 11:30 Central African Time with Makeda Mahadio on Parliament East Africa. You can follow more conversations on Twitter at CNBC Africa, my personal handle at Michael Mjisha.